Welcome back to another edition of the NobleAgent.com video blog. This week I'd like to talk to you about the interest rates for loans and how that can affect you in the way of purchasing power, as well as if you're an existing owner and you'd like to change or modify your loan. Let's talk about number one, your buying power and how that's affected by the interest rates. The interest rates have dropped a bit, and they're significantly lower than they were a year ago. And what that means to you is, as a buyer or consumer, is if your interest rate was at, let's say, 6% last year, or let's even say 5.5%. I mean, you're looking at, for a 30-year fixed loan, about 4.75%. Now, how does that affect you? It means that for every $100,000, as an estimate, if it was at a 5.5% interest rate, you're probably paying principal, interest, taxes, and insurance about $625 a month for every $100,000 borrowed. Now, with an interest rate of, let's say, 4.5 or 4.75%, you're only paying probably $5.25, maybe $5.50 for every $100,000 borrowed. That's roughly a savings of about $75 a month per every $100,000 borrowed. $400,000 loan amount, you're looking at about $300 a month in the way of savings. So either you take that and you say, okay, I can obtain a mortgage at the same amount but pay less a month, or I may be able to afford more of a home in the way of, okay, if I want to get the payment to about the same thing as it would have been 6 months or a year ago, I can look at properties. Instead of a $400,000 loan amount, I can probably look at a $450,000 loan amount. So it gets you more buying power. The other thing to consider nowadays is, with the interest rates on a 15-year note being as low as they are, meaning about 4.25%, you can actually pay off that mortgage in 15 years. Yes, it does mandate that you pay more money on a monthly basis, but you're paying less interest on the long run. So you need to know that. The other part is, consider refinancing your house if you've got enough equity, because the interest rates are so low, you may be able to really borrow the same amount that you have now and then lower your payment by a significant amount of money to help you save that. You can put that towards equity, you can put that towards whatever you want on a monthly basis, but you'll need to have equity in your property to do that. My recommendation, talk to a lender. Also, think about, when you're acquiring a new loan, that an FHA loan may be assumable, meaning down the road, if you want to sell your home, if you've got an FHA loan, it should be assumable to another buyer, meaning they could pick up and take over your payments where they are if they can qualify for the loan. And that means that these historically low rates would be available to the next buyer, which really increases, I think, I would say that the look of your home when you're trying to go market it and sell it. And you need to think about how that's going to affect the buyers who are going to be looking at your property in the way of value. If they can save money based on what the rates are 5, 6, 7 years from now, and more likely than not, they're not going to be at these low rates, it could significantly increase the value of your property to a buyer. Anyway, call us with any questions at 1-888-4-NO-BULL, and that's the Noble Agent video blog for this week.